Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another weekly economic review, this time for the week ending February 18, 2022. So a busy week again. Inflation remains very hot. So I'm sure you've seen many economists like me on TV during the week discussing what's going on, what are the forecasts. So the good news is that we're probably nearing the top for inflation. We'll dig into that in a second. But also in the markets, Russia, Ukraine, geopolitical risks usually don't change the trajectory of the markets, but they can lead to bursts of volatility, and we seem to be in one. So we'll make sense of everything right now. All right, so looking at the markets this week at the close on Thursday. So again, a lot of red on the screen. Interest rates higher because of the inflation surprise. So that leads to losses in bonds. We're still at about -5% for the universe index for bonds. So the broad index, the long index -9.3. So it's still near -10 on the year. Corps down 4%. If you look at equities, well, the TSX and emerging markets are still leading the way year to date. So this is where we are positioned more strongly. We have a very positive outlook on the TSX emerging markets in Europe in 2022. So some leadership that remains there, but still on the week, the TSX was pushed lower, especially from a lower price of oil. So down 1.66% on the week. But year to date, NASDAQ, S&P 500, they've been hit pretty badly. Other markets, the price of oil down. I mean, you have this geopolitical tension coming in, so you have volatility. So we've had a few very strong weeks. Now we've had a weak week. We'll see what the future holds. But US dollar was lower, so higher CAD, higher euro, and the price of gold coming back to life this week. Volatility, gold, we have a geopolitical environment, so there might be a trade for gold, but in our funds, we have not added. There's just so much volatility around that theme right now that we haven't really wrapped our mind around adding gold in our portfolios yet. Canadian inflation, so at the 30-year high, so that's the highest since 1991. So again, what this means very concretely is that the price of the basket that you spent, that is bought by the typical Canadian household, as went up in price by 5.1% between January of 2021 and January of 2022. So of course, this is the typical basket. So your consumption, my consumption, everyone's consumption differs from the basket. So inflation is hitting some households more, some households less, but it's very hard to avoid this inflationary push. So shelter. So if you're an owner, so that's a positive that raises your value. If you're a renter, that bites. If you buy food, everyone buys food, so you can't really avoid food inflation. Transportation. So if you're in the market for a new car or used car, you know that prices have been high, and the price of gasoline, of course, is strong too. So it's really hard to avoid what's going on here in inflation. But the good news is that the consensus of economists, and I agree with that, we all think that probably we're at peak inflation and we should be coming down throughout the year. Now, how low will we fall on inflation rate and how quickly will it fall? That's still very much up in the air. But I thought here that I'd bring the latest tables from the monetary policy report from the Bank of Canada. Their job is to control inflation, so they have a good views on inflation dynamics. And this is what the Bank of Canada expects. So 2022 Q1, Bank of Canada was expecting 5.1% inflation, and that's exactly what we got for January. So that might be the peak here, according to them, because 2022 Q4, the red box on the right, the top right of the table, they're forecasting 3% inflation by the end of the year. So going from 5.1 to 3. So how are we going to get there? According to the Bank of Canada, probably should be during the second half of the year that will be coming down pretty quickly. I agree with this thesis too. There will be a topping process at the beginning of the year, and then we should fall down. 2023 Q4, the bank forecasts 2.2% at the end of the year, so near the target. So remember that it's a target range that the Bank of Canada has between 1 and 3%. So 2% being the middle of the range. So when you're back to 3% for the Bank of Canada, that's more or less a mission accomplished. It's within the range for inflation. So good news there. I agree with that. Consensus of economists agree with that. That's the view of the Bank of Canada. So probably inflation rate will be slowing down. Now, don't mistake inflation slowing down with prices going down. Right? Just the pace of acceleration. So it won't start to cost less at the grocery store, but at least the pace of inflation will be calming down. Here I brought this chart. It's an interesting one. Remember, I post this slide deck, the PDF of the slide deck on LinkedIn every Friday, so you can have access to that. Just connect with me or just do a search for my name on LinkedIn. You'll find the slide deck. And this is how they view the dynamic of inflation. So as you can see, there are many sticks there, so that have been contributing to pushing inflation. So commodity prices, other factors, as they say. So it's a combination of many things, but all of these factors should start to slow down in at the middle of 2022, and then we should see inflation falling down pretty quickly. So that's the game plan. That's the base case. So we'll see where it goes, but I think it's good news that probably we should not expect this inflation regime to last and to keep on accelerating. So now financial markets, of course, Russia and Ukraine. So how much of a risk? So I'm not a geopolitical expert here, so I won't be going to the geopolitics of that. But Mr. Biden says that there's every indication that Russia is prepared to attack Ukraine. And as I'm recording this, it is Friday morning. It's 9:20. And about 30 minutes ago, some news hit that there were even more troops gathering near the Ukraine border. So the risks are real. Now, what history tells us for the markets, I can talk about the markets. In the markets, when you have geopolitical events like that, that leads to short-term volatility, of course, but long-term, it doesn't really derail the market. So the earnings profile of all of the business on the S&P 500 are not impacted by that. Same thing for the TSX, same thing for emerging markets. So it's more of a risk event that can derail risk sentiment in the short term. So if we look at similar events, of course, here it's just military events, geopolitical. They're not all equal. So Pearl Harbor was more important, let's say, than some other events here. But if we go down all the way to the Iraq War, what we know, what we've seen in the past is that 1 month later and 3 months later, the markets are on average positive, but the percentage of times that it's positive, it's very close to flipping a coin. So you don't know in the short run. But 6 months later and 12 months later, then the numbers become interesting. So these geopolitical events are usually good moments to put some money at risk if you have a time horizon that is longer, let's say, than a year. So, and this is our RRSP season, so it's a good time to put some money at work. If you can take some short-term volatility, buying these events typically is a winning strategy. Taking a step back even more, now we know that this is a question we've been asked a lot. Well, the economy is decelerating and rates are rising. So what should we expect from equities, from stocks? Well, history here, and this is a table we got from Goldman Sachs, tells us that, well, if the economy is growing and accelerating, it doesn't matter what rates are doing. You'll have some good returns over 12 months on the S&P 500. This is since 1975. If the economy is stable, yeah, if rates are rising, that could eat a little bit into the prospects for equities. But if you have decelerating growth, but still growing, so the economy is still growing, but it's decelerating, and then when you have rising rates, it eats a bit more into returns, of course, but it's still a healthy 8% return on average. So would it be 8? Will it be 3? Will it? But it's just on average, you have positive returns. So you want to avoid the bear markets. You want to avoid the recessions. That's when you want maybe to shy away from investing. But here, spending some time in the market still makes a lot of sense, even though we have decelerating economy and we have a rising rate. So that's what I wanted to share. So it's still supportive for stock returns. It's always important to have a long-term time horizon, of course. So what to watch next week in the US? We'll have the Conference Board Consumer Confidence Index and the University of Michigan Confidence Index. So two indices that are diverging right now. The University of Michigan one is very sensitive to inflation. So let's see if it keeps on falling. We'll have the core PCE deflator. What's that thing? It's the inflation rate in the US that is followed closely by the Fed when they make their decisions. So it's the most important one to follow if you look at what the Fed is looking at. So consensus is 5.2% year over year, which is similar to the headline rate we had in Canada. Personal spending and personal income. So all of this data coming out next week, and we'll be covering that for you. So that wraps it up for the week. ia.ca/economy. Economy and Finance 101. There will be some material added over the next few months. I mean, we've been delayed a little bit by the volatility at the beginning of the year, but we'll be adding a lot of material through the year. So we'll keep you posted. And for social media, Twitter, LinkedIn, that's where you can follow us on an almost daily basis. So thank you, everyone. It's always a pleasure to serve you, and I'll be there again next week with another edition of the Weekly Review.